This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Romano, thanks very much for coming back on Talk Your Book. Really appreciate your time. Before we get into your stock selection, maybe you could start by telling us about Katana Asset Management and how you guys look to invest.
Yeah, thanks, Chris. Thanks for having us back here again. So look, we are style agnostic, so we genuinely do look to try and employ the best precepts from all different investment styles. We're risk averse, so we're not about the best returns possible. We're about the best risk-adjusted returns. So we try and build a lot of buffer into everything we do. We run a very diversified portfolio, so generally 50 to 60 stocks. We don't borrow money, no derivatives, no short selling, long only. And, we often run sort of 15 to 25% cash to the cycle as well.
And what stock do you want to talk about today?
Yeah, I was a bit torn actually because I want to talk about Raise, but it's had a bit of a tear and I think it needs to consolidate for a bit. So I'm going to run through Tenna Securities, which is the convergence of what I term deep value with genuine earnings growth.
Now, I'm familiar with value. Talk me through deep value and what the difference is between the two.
Yeah, deep value is a term that we use for something that's another standard deviation, another measure again away from market averages. So, at the moment, value might be something with a single-digit PER or, 10, 11 times earnings versus your market running at 17, 18 times. But deep value is something where it's another level again. So it's something where it's right down at that 5, 6 times earnings mark. And the company's either priced to fail or it's priced to, at some stage, undergo a serious re-rating. And
talk us through Tenna Securities and their business model and what they do.
Yeah, so Tenna's a full-service bank based in, was just PNG. They've now moved into Fiji, so that diversifies their risk again. The CEO is the ex-head of Westpac Asia South Pacific, so he knows that space very well. And they were quite a sizable player already in the PNG market. But then in September 2019, they had a very serious acquisition. They took out ANZ's PNG assets. And then probably the real game changer for them is December 2020, when they purchased Westpac's assets in PNG and Fiji. Now, that was a really serious acquisition for them because, it's moved them into sort of second place pretty much overall, gives them a much larger balance sheet to get some of the higher margin sort of work and services, especially foreign exchange there. But it also substantially increases their economies of scale. And so, for example, with the Westpac acquisition, the customers increased by 400%, net loans are up by 275%, branches and ATMs up by 180%. So, they've really grown out that offering there. There'll be some huge synergies to come down the track. But also importantly, they diversify the risk base because they now become the number 3 player in Fiji with one acquisition. So it's really starting to build it out. And it makes sense because the banks, the major banks are looking to concentrate on core operations. Places like PNG and Fiji really are rounding areas for them.
Yeah, so it's almost buying a non-core asset. Do you feel like you're more likely to get some value? Because for those big Australian banks, they really just see that as a potential risk to their business model and not something that's really going to drive shareholder value. So their main interest is to just get it off their book expeditiously rather than try and get, the biggest price possible and continuing to hold that business unit for a longer term time frame.
Yeah, look, spot on. I mean, the danger for Westpac and ANZ was that they had to make sure that whoever bought those assets was a safe pair of hands because they could have undergone serious brand damage if they had gone into the wrong hands. There were some other suitors that were probably going to potentially create some problems and be on the track. So I think if you look at the price that they, for example, the Westpac transaction, they picked up 55% of that acquisition was in capital. So they pretty much, covered half that purchase cost as it is. But also importantly, they bought it on a COVID impacted year. So the multiples they paid were on a year where COVID had probably taken somewhere around about a third off the top line and the bottom line for Westpac. So they bought them on depressed earnings already. bought it at sort of 0.4, you know, 0.5 times book value. So, you know, they've picked up some very good assets that they know very well that are right in their sweet spot. I mean, no one knows these assets better than the team at Keener. And importantly, they'd already raised all the monies they needed to, and we'll see a couple of very important multinational development banks come in to do the debt and capital raising to round out the acquisition.
I think Westpac took a $230 million loss on that asset sale, so that probably gives you some flavour of their willingness to just get it off their books. You mentioned the CEO being ex-Westpac. How does that relate to the integration risk when you're buying a business that you should know intimately well?
Yeah, exactly that. I mean, it reduces the risk substantially because he's got a long track record of operating those jurisdictions, especially PNG and Fiji. So, you know, he's familiar with all the nuances that goes along with that. Secondly, he knows those assets quite well. And, you know, thirdly is the fact that, you know, he's operating already a bank that's, you know, was number 2 in the retail space prior to the acquisition. So he knows how the demographics, what the loan books look like and how they're likely to perform, you know, what growth you can expect to see, what areas to target. I think it's also important to note too that, you know, if you look at the senior management team, that 3 of the senior management team are also ex-Westpac executives. So in that region. So, you know, he's brought in a really good team. When he came to Keener Securities, he had a vision for building it out, and he's certainly doing that now. And he's built out a frontline team ahead of the curve, and now we're starting to see why he's brought some of those people in.
And we'll get to the numbers shortly, and I think you phrased it as deep value, but to me it looks bloody cheap. The reason I guess it's cheap is it's not a very well-researched stock by investment house in Australia, but it's also based in PNG and Fiji. What sort of work have you done, or how did you get comfortable with being in those jurisdictions? And perhaps what's the helicopter view of those 2 economies?
Yeah, look, they're both really important points. Firstly, on the research front, there's only one broker, Morgans, at the moment that are covering this stock, and that's the risk and the opportunity. So it's a risk, of course, because with only one broker covering it, the house broker, then, you know, the level of analysis and due diligence and so forth is a step removed from where you've got, say, 3 or 4 tier 1 brokers. So that's the first issue. But the opportunity there, of course, is that, you know, Morgans have a great track record of identifying stocks ahead of the curve, especially in this market capitalisation range. And if this is another one of those stocks where in due course we start to see other brokers initiate research coverage, then invariably that's a great trigger for re-rating the share price. So that's the first thing. In terms of jurisdictions, look, the reality is, Chris, is that, you know, we're not close enough or clever enough to know things ahead of the curve. So by the time we're starting to see the loan books perform in a way that we would not expect them to perform, it'll already be factored in the share price, and we'll be reading the same as everyone else. So what we've had to do there is understand, firstly, the historical machinations in those jurisdictions, and we haven't done so much Fiji, but certainly PNG. Understanding traditionally how loan books run, you know, bad debts and doubtful debts and arrears and so forth, and just get ourselves broadly comfortable with those metrics. But then the reality is what we've tried to do is build in so much of a buffer that even if we see things that we don't expect to see, we are pretty much protected from those outcomes. And as an example, I mentioned that, you know, on the Westpac component of the transaction, they picked up a 55% capital, you know, as opposed to, say, an Aussie bank, which runs about 11% capital. Now, if you look at what that means overall, it means that Keener is probably going to be running somewhere around about 39% overall capital ratio, which is a huge buffer to enable them to take on some big hits to the bottom line and still not even really flinch. So we tried to, as I said, you know, if it's companies that we can get more access to them and closer to them, better understand them, then we'll do the work. Otherwise, you've got to have that buffer, that risk margin. And in this case here, we think we've got that.
And so talk me through some of the numbers. Talk me through, so the market cap, the PE ratio, and what the current dividend yield is. Yeah,
so market cap, you know, it's mid-range there. So we think it can sort of very easily head up to that 500 to 700 million market cap there around the target price of $1.50. So it's not tiny. Liquidity is improving, which is probably more important than market cap for us. So you can get some really small companies with good liquidity and some larger companies with poor liquidity. So liquidity is turning over the stage where it's probably about 2 days turnover for the size that we're looking for. So not great, but not poor either. And certainly we're seeing since the last capital raising, we've certainly seen the liquidity take a milestone incremental improvement. So that's the first thing. Look, in terms of numbers, on our numbers and based on what the work that we've seen from Morgans, we're looking at around about 6.5 times on the current year's earnings, moving to around about 4.5 times next year, because in the 2022 financial year, we'll start to see all the synergies come through. So all the numbers that have been modelled for this first year are pre-synergies. There's bank branches that overlap, there's ATMs that overlap, there's credit teams that overlap, there's all these things that overlap. They're going to be able to pull out some serious capital, some serious operational savings there. So, 4.5 times 2022 earnings looks realistic for us. It's not a huge stretch. It's taking it back to EPS levels that it was sort of 12 to 18 months ago prior to the last capital raise. So that's very feasible. Yields are sort of looking at just under 10% for this financial year. And, the numbers out of the Morgans is up at 16% for next financial year. We're not too dissimilar. We see that the capital buffers and ratios are so flush there that if they deliver on the profit in the way that they anticipate, then we will see a very serious level of capital come out to shareholders.
Are they franked or unfranked, those yields?
So the dividends are unfranked, being because all their earnings are offshore. So that is one thing to take into consideration. But even at, say, 9.5%, 10% for this year, it's probably 3 times your franked yield from banks, or say 2 times your grossed up yield on the banks domestically.
And in terms of a stock like this, if we're in the euphoric stage of a bull market, we're seeing the buy now, pay later stocks just going berserk. A lot of the penny dreadful mining stocks are on a tear. Not being invested in this late stage or this euphoric stage is a risk because capital appreciation is so swift. But by the same token, if you are just in the names that are exploding, you're exposed for when and if a correction does come. Do you share that sort of philosophy, and do you find some comfort being in, how you phrased, a deep value stock at this stage of the bull market cycle?
Look, you're spot on. I mean, we're definitely in the euphoric phase of the bull market cycle, the fourth stage. Now, that can be an accentuated phase. So we could have quite a few months to run yet. So from that end, I think there is risk, but it's not at the back end of that phase. In terms of where we see this is where you make your quickest money, your hottest money, your biggest money, but it's also the riskiest money, most definitely. And you're spot on, because there's a big gap between a hot stock with no valuation support and a company that's got that genuine valuation support. So, certainly from our end, we'd like to, and we'll play all ends of the market. We're playing the buy now, pay later stocks. We play them a different way. We're playing them with very strict stops. We're playing them as a momentum trade. We understand there's no intrinsic value in some of these companies. And so when the price dips, it's straight out. When the price dips on something like Kina, we're more likely to allow it time to rest, make sure, double check our thesis, and then probably add to our position.
And talk to me about the yield curve steepening and what that can do for bank margins. Obviously, over there in WA, there's a lot of resource investors that are looking at the 10-year in the US going up and thinking it's going to be good for resource stocks. But how does that translate into the potential for bank margins as well?
Yeah, you're spot on. I mean, we've really been in a tough environment for banks because we've had a declining yield curve. As the yield curve starts to recover, and we're seeing 120 odd over for the US 10 at the moment, if that heads up to sort of 200 basis points over, then that creates a lot more scope for banks to expand their net interest margin, the NIM. They can do it in 2 ways, of course. They can hide a lot more margin there. And also, of course, the jaws, the difference between what they're paying on, say, deposits versus what they're lending money out at. So, banks are one of the major beneficiaries, along with the resources with inflation. Banks are one of the major beneficiaries of a rising yield curve. And I think that's been lost on a lot of people. I think we've had a one-way yield curve for 35 years, literally. I think as this starts to turn around, I think they'll come into their own a little.
Beautiful. Well, it's the very idea of Talk Your Book was to get stocks on on my radar and on the viewers' radar that not too many people are talking about, and Keener Securities, I reckon, would definitely fit the bill. So it was an awesome pick, and thanks very much for coming on and talking about it.
Pleasure. Thanks, Chris.
See you, Romano. Catch up.
Cheers.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.